Good day, everyone. My name's Chris Kimble, founder of Kimble Charting Solutions, and today's election day. I know you've been waiting on this a long time. Today's November the 3rd, and welcome to today's edition of Your Daily Five. And so today I was trying to think about, what could we do maybe differently on election today? And so I wanted to kind of talk about bonds and I wanted to pose this question: is the 40-year bond bull market finished or over? And we know in these bullfights that the bull doesn't typically have a good ending, and so we want to see, is the bond bull market tiring, and could you make an opportunity out of it? And if the answer is yes, that it is ending, there's a lot of wonderful opportunities. So I wanted to kind of discuss those today. So this is a look at the ever popular yield on the 10-year note going back into the 1960s. So if you do the math, we're looking at more than a half century, 6.5 decades of 5.5 decades of chart information here. But to me, the things that sticks out is we had a rise in rates, obviously, from the mid 60s through 1980. The 10-year note peaked at around 1584. And then it fell, obviously, for a long period of time, and it kept creating lower highs. And so the low this past summer was 0.52, and yes, I know that's correct, a 0.52 on the interest rates, and then we've seen a little rally from this. So the question to me is, what would it take for the bond or the interest rate bear market or the bond bull market and prices? What would it take for it to be over? And from a yield exiting a bear market, would the bear market and yields be over if yields reached about 1.5%? Or would yields would the bear market in yields be over if they reached 3%? This level here, or how about 5, or how about 8%? I've got to say this humbly, everyone, is, sometimes, when you say that a new trend has started, or an example of this, a bear market is over with, would it be fair to say to call the bear market and yields over? Would yields have to get above 16%? I don't know, but I really think it's the wrong question to be asked. And the friends that have asked me this, is the 40-year bear market over? They didn't ask the wrong question, but I think it's just going to take a lot longer to know. But the key is how could you make this into an opportunity in the much shorter term? And so I wanted to kind of look at the 10-year yield over the last 30 years, cut it in half, and you'll notice that there's this falling resistance line, and then we see a little push higher, and then above is the momentum index. And again, this is on a monthly chart. So I wanted to kind of show any time over the last 30 years that momentum was deeply oversold, there were counter trend rallies in interest rates. As an example, in 1998, you can see yields rallied from 4 to almost 7. That's a 70% rally in rates. And here, 4 to 6, a 50% rally in rate. And here, 2.5% to almost 4. That's a large percentage. Again, here, from under 2 to 3.5. It's almost 100% again. So here we are down here testing a support line. Momentum is the most oversold in multiple decades, and we see a push higher. So I brought in these arrows just to kind of highlight where bonds were typically when monthly momentum was as oversold as it is today. And it ended up being opportunities to either harvest your profits in bond positions, or maybe bet against it and try to profit from rising interest rates. So this is a rare situation. And again, this is the 10-year yield. And now we'll go on the opposite. Let's look at really short-term yields. And so here's the yield on the 2-year note. And you can see that obviously interest rates have just collapsed. And one of the sharpest collapses you can see in the last 40 years. And the 2-year yield did break below the 2011 lows. So this was support. Support failed to hold. And now interest rates are kissing the underside of old support as new resistance. And so there's an attempt by the 2-year yield to push back above old support as new resistance. And then you'll notice that, similar to the prior chart, momentum is deeply oversold. And any time, even though the bear market in interest rates continued for decades, there have been quality counter trend rallies. And that's what today is about, is what do you want to look for, or what should you look for on a counter trend rally, and how could you take advantage of it? We've been sharing with our members that interest rates formed one of the largest, from an interest rate perspective, the largest bullish reversal in the history of rates back in March. And this is on a monthly pattern basis. And so we've been talking with our members for quite some time on this, but I just wanted to kind of share over the last 90 days, and this was through the 1st of November, and today's November the 3rd, but over the last 90 days, I looked at inverse bond fund TBF. It's up just short of 6%. The Nasdaq's up 1%. The S&P's up 0.5%. And if you're long TLT, the popular long bond, it's down 6.5%. So you can see during the this time frame that if you're an asset allocator, that stocks in just a 90-day window don't have a lot to brag about. But then if you're a 60-40 portfolio, the 40% of your portfolio has kind of struggled, of late. So again, there's opportunities, and I want to confirm today, I do not know if the 40-year bond bull market is over, or the bear market in yields is over with. And humbly, I don't care, because it's going to take a long time to tell. But again, today's talk is about opportunities in the in-between time. So this is from StockCharts. This is a look at TLT on a monthly basis from its inception. And it's still, as you can see, in a bull market. And a couple of times it hit the top of this rising trend channel as relative performance, or 2-year performance, was above the 40% level. And you can see that each time it did that, TLT still remained in a long-term bull market, but it did struggle for a while. You can see that TLT was close to 95, and then here it was 65, and then here again it was 110, and then it was around 85. So it did experience some sizable pullbacks in this long-term bull market, that it's in. So this is a time, and you can see in the last 2 years that TLT is up 43%. So it could be a time that it could back off a little bit. So the main play on rising interest rates is TBF. And so you can see TBF has really stunk it up over the years as interest rates have fallen. It's down close to 50% over the last 4 years. Been a great place to avoid, but now it's looking at, is this a time to start accumulating some of this? So TBF has traded sideways for the last few months in here. And this is a monthly chart. You see last month it did close at its highest price in the last 6 months prior to this very large reversal that took place in the month of March. So another play is, as we kind of wrap this talk up, is trying to think about how can you take advantage in this sector. And the black line is the S&P, and then the blue line is the ratio of banks to the S&P 500. And you can see this chart goes back again over 30 years, that the spread, the underperformance of banks to the S&P has never been this huge in the history of the banking index. And so this spread's got to narrow. So one of two things need to happen. Either the S&P needs to come down and banks are flat, or maybe the S&P goes up, banks go up even a lot more. And you see this little curl right in here, taking place. And so this is the same chart that we looked at earlier, the 90-day performance, but you'll see I added this time XLF, and you can see that banks over the last 90 days are actually stronger than the S&P and the Nasdaq. And so historically, if interest rates do rise, banks are a good place to be. And see, that's probably why folks at banks have been a place to avoid, because rates have fallen obviously so much. But we're trying to do the Wayne Gretzky thing, trying to skate to where the puck will be. And so as I finish up today, this is a look since essentially the lows in stocks in September. You'll see that the S&P is up 2%, but bank ETFs, which is XLF, is up 5%. But I want to make you aware, if you're not, of RYF, and that's the equal weighted bank index that suffered a lot over the years. But you can see since the lows in September, it's up 9%. So it's up 7% more than the S&P, and it's up several percent even more than the bank ETF itself. So if rates rise, XLF and RYF should do very well, and so should TBF. So as we finish today, thanks for joining us on your edition of the Daily 5. If you want to see a special offer that we're offering to new members, go to kimblechartingsolutions.com/stock charts. Thank you, everyone.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.